What's happened?
Welcome everyone to today's RAAS Research Group Stock Take webinar, where we will be analysing Australia's leading online marketplace for local services, AirTasker, ASX code ART, who recently released their half-year results. RAAS Research Group analyst John Burgess, who recently released research on the company, will be providing a overview of the company and those results. Webinar where we will be analysing Australia's leading. Everyone, just bear with me for 1 second.
Sorry, guys.
All right, a slight technical issue there. As I said, John Burgess will be providing a presentation on the company and his review of the company's recent results, after which I will be welcoming AirTasker CEO Tim Fung and CFO Mahendra Tharmarajah to present on the company. At the end of their presentation, there will be a live Q&A. So if you have any questions, please submit them in the Q&A box on your screen, and I will put them to the appropriate person following the presentations. Thank you for joining us, and without further ado, let's get started. Please join me in welcoming RAAS Research Group Senior Analyst, John Burgess. John, over to you.
Thanks, David. If we go to the slide, the agenda slide, I just thought we'd touch on the H1 results. I'm sure the company will do the same. But post-results, with all the peer results in, we've had a look at some of the key metrics of AirTasker relative to peers, which we'll go through, and look at the media spend upcoming, and also, I guess, we've changed our valuation approach for a few reasons, which we'll take you through. So let's get started with the next slide. I thought, obviously, these are all, have been released, but as a reminder, revenue growth for the group was up 11%, which you'll see in future slides, was at the top of our selected peer group, with the AirTasker marketplaces closer to 15, and international revenue growth was 110%. So we're seeing some early signs of the ad spend, and perhaps some discretionary spending sort of bottoming. And in that light, GMV, as far as we can calculate, was positive in Australia for the first time since H1 FY23. So whether it's marketing, whether it's cycling weak consumer spending, or a bit of both, it's obviously a very positive thing for GMV and then revenue, which flows from GMV. I think as the company and we have spoken about previously, it's probably a big sort of focus over the last 18 months, and the monetization rate, which is the revenue to GMV, if you like, was up 140 bips due to improvements in the platform's efficiency, mainly to do with cancellation fees being introduced. And I suspect the key benefits of that, of those, particularly the cancellation policy, are probably in the numbers now. We saw the last of the big jump in H1 25, but there'll probably be some minor improvements over the next couple of years that can be made to tick that up a few bips. The big theme, the big key, and probably will be the big key for the next couple of years, really, is the marketing spend, which for this half was about $18 million, $18.1 million, which is a significant increase on previous years. It's partly cash and mostly non-cash, but nonetheless, we're seeing a big marketing effort across Australia, the US, and the UK, which we'll run through in the next few slides. Costs were pretty well controlled. Ex-marketing up 13%, and the EBIT was a loss of 9.9, but about a profit of 0.9 if you exclude non-cash, and that's sort of whether you do that or not. We present both cases. So next slide. So I want to touch on the marketing spend of AirTasker relative to revenue. against the peers. And in the first half of H125, on the slide there, you'll see that they were 71%, which is a big increase and a big discrepancy relative to peers who sort of average between 11 and 29. So, I think that's we're getting a feel for the magnitude of the marketing spend of AirTasker, both cash and non-cash. So 60% of that spend was non-cash, but nonetheless, you're still getting, some sort of benefits near and medium term for that spend. Step one was the nearest. So then step one's an e-commerce rather than a marketplace, but it's still it's a loose peer, and Camplify, which is CHL, ASX code CHL, it was probably the closest marketplace peer at 27% of revenue. So it's, relative to peers, we're seeing a real increased marketing spend for AirTasker. If we go to the next slide, and that's resulting in you're seeing the early signs of superior revenue growth relative to the peers on the back of must be some of that marketing spend coming off. So again, as we mentioned, revenue growth for AirTasker in the latest half is a fit 11% and 15% for the AirTasker marketplaces. And again, the closest peer increase was High Pages, HPG at 9%, Step One at 7%. So, I guess that's what you want and expect to see, revenue growth outpacing peers because of accelerated marketing growth. As I say, marketing must be a contributor, and it will continue to be a contributor in the next sort of 12 to 18 months. If we go to the next slide. So we're seeing, if we drill down a little bit more, we're seeing UK revenue up 100%, US up 193%, and as I say, the Australian marketplace, which in terms of GMV, saw the first positive growth since H1 FY23. Where this spend will accelerate. If we go to the next slide, we'll see that. And so this is the marketing spend, both cash and non-cash combined. Our forecast for marketing spend between, historically actual, and then obviously forecast into 25, 6, 7. And you'll see in FY25, we forecast about $48 million in total marketing spend. So from that first half of 18.1, we're looking at 30 million second half. So we're really amping the spend up, or AirTasker up, and we should, by all theories, see that revenue growth also begin to ramp up from that 11% sort of first half number because of the magnitude of the spend. As the company, and we have talked about in the past, this marketing is not necessarily, you don't necessarily see the benefits of it when spent. There must be some short-term benefits, but a lot of the driver is expected to be sort of brand awareness over the medium term. So it's a medium-term benefit as well as a small short-term benefit. So we go to the next slide. I talked about valuation, how we've moved that approach. We used to have some of the parts looking at Australia versus the international component. The problem we're having at the moment is that a lot of the peer groups are actually losing money or losing more money. So it's hard to get a peer sort of EBITDA multiple to apply to the profitable Australian business. And then what's making that even more complicated is the non-cash marketing spend within AirTasker, which is distorting their reported results. So it makes actually deriving an EBITDA number more difficult. So we've moved to more of a traditional DCF approach, and our valuation sits at about 64 cents. The key to the DCF, it really is the benefits, forecasting the sort of 5-year benefits of this current elevated media spend into revenue, and exactly what sort of growth rates in revenue are going to result from that elevated spend. And that's obviously very difficult. You have to have an estimate, and we've laid those out. But That's the key, to sort of deriving value here. I guess to account for that, we have applied a beta of 1.2, which is relatively high, given the Australian business is profitable, and that's really for the forecast risk in trying to estimate those revenues over the next 5 years that come from that marketing spend. And then we have our estimates are out to about FY28, and then sort of beyond 28 to the terminal period, we've only got 10% medium-term growth in our numbers at the moment to derive that valuation of 64 cents. Move to the next slide. And so, as we talked about there, in terms of key sensitivities to near-term earnings and obviously our valuation, it's all about the international revenue assumptions around what the current and future media spend is going to derive, and same for Australia. Less so in terms of Australia because it's a little bit more mature, but still has the ability to grow significantly off its current base. But the international business is obviously much smaller than Australia, and so just the revenue opportunities over the next 5 years, is clearly key to our earnings and our valuation. And then obviously once that sort of significant spend that we've highlighted the next 2 years drops off in terms of non-cash, what's the medium term sort of sustainable media spend required to keep the business in steady state, if you like. So I can't remember what we're using off the top of my head, but it's certainly something around that 15% of revenue, which is obviously not 71, which it is this year, or this half, I should say. The constant issue, I think, for AirTasker is the ability to keep users on the platform. So any sort of innovations that can be used to increase the usage of the platform, is certainly a sensitivity. And as I say, as I touched on the DCF, the discount rate we're using, which is relatively high, and if we see some really good revenue numbers over the next couple of years from this media spend, it certainly has the ability to come down. So look, I think that's my last slide, David, and my summary is really, we're seeing the good early signs of revenue from the ad spend. The ad spend is really picking up in the second half and into FY26, and so it's just really a question of watching that the revenue growth that comes from that ad spend, and trying to figure out trying to keep track of it.
Thanks, John. A great overview of the AirTasker business. As I mentioned in the beginning, John has produced research on AirTasker and particularly its half-year results, and that is available on the RAAS Research Group website. John will be back later on to answer any questions that you may have, but for now, I would now like to introduce AirTasker CEO Tim Fung and CFO Mahendra Tharmarajah, who will run you through the half-year results and then be available to answer any questions you may have. Gents, over to you.
Thank you so much, Dave. If we can flick forward 2 slides. So first of all, thanks everyone for joining us today to go through the half-year results. I think we've made some really strong progress, so really keen to keep you all updated. As a quick reminder about AirTasker, on the next page, we're building the world's most trusted marketplace to buy and sell local services. Really simple business model. We connect people who need work done with people who want to work. On the next slide, our mission is to empower people to realize the full value of their skills. We believe that every single person has unique skills, and we're here to help them monetize their skills to generate an income. And I think in the age of autonomy and robotics and all of these things taking people's jobs, it's really important that humans are always on the cutting edge of being able to do new and more creative things to help others in the community, and this is what AirTasker really embraces. On the next slide, the way that AirTasker is building a services marketplace is quite unique. The first thing that we're doing that's unique is that we've built it as an open community platform. So we don't set the prices, we don't tell the taskers what to do or micromanage them. We simply build a platform that allows you to connect as a tasker, a person who wants to do work, with a customer, a person who needs work done, and we enable the payments, the insurance, all of these things that are necessary to do that. Because we have this light touch operating model, we have gross margins about 95%. So it's a great business. On the second half of that page, AirTasker is infinitely horizontal. And what that means is you can post any kind of task you need done on AirTasker as long as it's within the law and our community guidelines. And what that means is that we can capture and address a lot of these services that don't fit neatly into other categories and so can't be done anywhere else except AirTasker. So it's really powerful as a point of differentiation. It's also the thing that makes our marketing and unit economics really stack up. A lot of people hear about AirTasker because of all the cool tasks that get done. That drives earned media and PR, and that means that we're not beholden to Google and paying Google tax on every job through performance marketing. If we go to the next slide, in terms of competition, I think that there's two ways to segment the market that are useful. The first is to look at remote platforms versus local services. On the left-hand side there, you can see companies like Fiverr and Upwork, which you may have heard of, and they're predominantly got a similar business model to AirTasker, but the customers that they're serving are people who are in generally high labor cost countries like Australia, the US, the UK, who want to offshore that work to someone in Bangladesh or India or the Philippines where that labor is a lower cost. So that's sort of like the remote outsourcing model. For the local services models, a good way to segment is that there are a group of advertising type businesses, for example, High Pages, Facebook Marketplace, Angie's List, Thumbtack and Checkatrade in the US and the UK respectively. And these businesses are effectively an evolution of the Yellow Pages. People used to pay money to be listed in a directory, and now people want to pay money to a platform to be listed on a website. AirTasker and TaskRabbit are doing something a little bit different to that, which is that we are an e-commerce model. Our customer is the actual paying customer of the services itself. And so you come to AirTasker and all the payments come through us, and we actually manage the jobs end to end. But AirTasker and TaskRabbit are doing something a little bit different. TaskRabbit has built a curated supply model, essentially like an Uber for IKEA furniture assembly type model. And that model has pros and cons for sure, but one of those things is a little bit more of a higher touch business. You know, you're setting the prices, you're managing the taskers, you're curating the supply, versus AirTasker, which is a much more light touch, platform-driven operating model. Perhaps an analogy that's relevant is that TaskRabbit's a bit more like Netflix and AirTasker is a bit more like YouTube. If we go to the next page, we've got a really, really simple business model. All the payments go through the AirTasker platform, all the cash goes through our business. We call that the gross marketplace volume, and that doesn't hit our P&L. That's just the cash flows through the business. Out of that gross marketplace volume, or GMV, we earn about 20.7% of that as our revenue. That's our monetization rate. And from that revenue, we have about a 95% gross margin. We're paying a little bit under 1% for insurances and about 3.5% of that in payment costs. And the rest of that is dropping to the bottom line. So about a 95% gross margin. So again, a really, really strong and scalable business model. And with that, I'm going to pass it on to Mahendra to talk a little bit about how we performed in the last half. Over to you.
Great. Thanks, Tim. Thanks, David. Next slide, please. I might start with looking at a summary of where we performed in the first half. So at the start of FY25, we provided some guidance around three things we wanted to try and achieve over the course of FY25. So the first one was to be cash flow positive, free cash flow positive over the full year. And we're definitely on track to achieve that. We achieved a FCF positive number of 600,000 for the half year. This was on the back of a full year 24 result where we were about 1 million FCF positive as well. The second target was across our AirTasker marketplaces. So these are the marketplaces in Australia, the US and the UK predominantly, to achieve double-digit revenue growth. And pleased to say we hit a target of 14.8% for the half year. And that continued a trend that we started, I guess, in FY24, where we finished the full year at 9.8% up on the prior year. The first quarter of FY25 was sitting about 13.6%. The second quarter was about 15.8%. And then obviously the blended result was 14.8% revenue growth for the half year. And then the third item was really to close out a number of media deals, media partnerships that we were working on in the background. And we were pleased to announce that we closed about $51 million worth of media partnerships across Australia, the US, and the UK in those last couple of months of FY24 and the first couple of months of FY25. Next slide, please, John. Stepping back and looking at the group result, the group revenue growth was 10%. So the group comprises two marketplaces, our OneFlare marketplace in Australia, as well as the AirTasker marketplace I just mentioned across the US, Australia, and the UK. And then, as I mentioned, AirTasker marketplace's revenues, it was just under 22 million, 14.8% growth. Free cash flow of 600,000, an improvement of about 105%. And then positive operating cash flow, our third consecutive half of positive operating cash flow, an improvement of 36% year on the PCP. Next slide, please, David. Looking at how our segment data and our EBITDA numbers break out, the core part of the business is really the established marketplaces in Australia. So this is our Australian AirTasker and OneFlare businesses. They generate about 14 million of EBITDA, down a little bit on the comparative period, mainly due to the fact that we increased our marketing investment significantly. So the marketing for the half in the AirTasker marketplace in Australia was about 4.5 million, 2.6 of which was non-cash above the line brand marketing through our media partners, oOh!media and ARN. And then that contribution covers all our fixed costs, our corporate head office costs, which is essentially our platform engineering and product infrastructure, our back office teams and finance and HR and legal and so on, and the leadership team. And that leaves us about 4 million of net EBITDA out of the Australian business after it covers our head office fixed costs, which then enables us to invest into our new marketplaces. So in the US and the UK, we incurred a EBITDA loss of about 14 million. That's about a delta of 9 million on the prior half. And most of that was due to the fact that we significantly increased our investment in marketing. And so marketing investment for the half was about 12.2 million into the new marketplaces, of which 8.3 million was in the form of contra media through our partners Televisa, Univision, and iHeartMedia. And we hadn't yet commenced using any of the media through the other two partners, Mercurius and Sinclair Media. We also had a non-cash unrealized loss related to the revaluation of our share purchase liability. So we have obviously obligations to repurchase the equity we've granted our partners in the US and the UK for our media partnerships. And there's a mark to market that occurs every half year. So that was 3.5 million of that 6.5 million. And then the other half, the other 3 million related to movements in FX as those obligations are denominated in US dollars and pounds sterling. We move to the next slide, please. If we look at the individual sort of marketplace, I've already talked about the AirTasker marketplace, the performance. If we look at Australia specifically on the right-hand side there, you can see our Australian revenue growth was about 11.5%, half on half, which grew faster than our GMV growth. So obviously the top of funnel marketplace revenue grew about 6.5%. GMV grew about 6.5%. But we've improved our monetization rate over the course of the last year or so. John mentioned earlier that we've improved our cancellation rate through the implementation of a new cancellation policy in HY24. We're certainly starting to see that come through. We've also had some good success with our above-the-line brand marketing campaign through oOh!media and ARN, which improved our brand awareness by about 7%, unaided brand awareness by about 7%. Next slide, please, John. If we turn to our international markets, so the UK and the US, the UK has hit a annualized GMV run rate of about 13 million, which is pretty significant for us in terms of its long-term performance, and it's on a trajectory to achieve the targets we're looking to achieve there. Revenue was up just under 100% on PCP. And again, that was faster than the GMV growth of about 65% on the half year. We also were successful in closing a follow-on investment from Channel 4. So we completed a media partnership with Channel 4 in June 23, where they provided us 3.5 million sterling of media capital. They followed that on in November 24 with another 4 million, which was really, I guess, a great testimony to, I guess, their confidence in the business and the performance of the UK operation so far. And we're about to head into the peak season in the Northern Hemisphere in both the UK and the US. So looking forward to a strong performance through the peak spring and summer seasons. In the US, much smaller market, still very early days. We commenced our marketing through Televisa, Univision, and iHeart in September, just after we closed those partnerships. We achieved revenue growth of about 193% on the comparative period, with slower GMV growth. And the deals we completed with those partners, Televisa, Univision, iHeart, Sinclair, and Mercurius, amounted about $22 million worth of media that we get to use over the next 2 years. We move forward one slide, please, John. Turning to, I guess, our guidance for the balance of the year, we still aim to be positive free cash flow over the full year FY25, delivering double-digit revenue growth across the AirTasker marketplace in Australia, the US, and the UK. The Australian operation, which Tim will talk about a bit further on, continues to generate sufficient cash to fund the cash investment into the US and UK expansion, maintaining our growth trajectory in both the UK and the US markets. And we finished the half, or started the second half, with just over $18 million worth of cash on balance sheet and about $45 million of unspent media capital from our media partners. Back to Tim.
Awesome. Thanks, Mahendra. Let's flick forward one more slide, David. So AirTasker's big picture growth strategy is that we have built a really great core platform in Australia. We're going to generate revenues and monetize from that core platform to deliver profitable growth. We're going to then use that cash, invest into the US and the UK to replicate what we've been able to achieve in Australia. And we're going to do that alongside some great media partners, which gives us a very efficient way of investing into those markets. So I'll take you through that, starting on the next slide. Investment into the core platform. So at the beginning of the year, we talked a lot about brand salience on AirTasker, and it feels like really important for us as a business to be able to increase the unaided awareness of AirTasker. So when you ask somebody, where do you go when you need your cleaning, your gardening, or your handyman jobs done, we want AirTasker to pop into their head. So we invested a lot into AirTasker's brand over the past half. We're seeing some great results with unaided awareness increasing around about 10%. And consideration on the platform increasing multiples of that number as well. So we're seeing those leading indicators come through. It is really important to say that investment into brand marketing is not specifically designed to deliver like a short-term juice to the numbers. What we're trying to do is build up that brand asset so we're not reliant on things like Google or Facebook, where they're extracting all of the profits out of those markets. So we don't want to be reliant on platforms. We do want to invest in our brand and have a direct relationship with our customers. The second thing that we're doing to invest into the core platform is investing into marketplace trust. So we rolled out some really great features over the past 6 months or so, including starting to ID verify all of our taskers after they've completed their first task. We've rolled out a top offer program. So now when you get a lot of offers on your task, a lot of people are facing analysis paralysis, and we're helping them break through that, increase their confidence in being able to find the right tasker for their job, and ultimately increase the rate of tasks that go from being posted to being booked, which is where we generate GMV. If we go to the next slide, our core platform can also benefit a lot from artificial intelligence in 2 ways. One is that the customer experience can be really enhanced. One of the things that makes AirTasker is friction in the sales funnel is that you as a customer have to write this whole task description, and with generative AI, there's a huge opportunity to make that job a lot easier and increase throughput into the demand side of our sales funnel. The other aspect is operational productivity, and we're already taking advantage of a lot of different products, whether it's our engineers using Copilot, whether it's in customer support using chatbots provided by Zendesk. We are already starting to see massive increases in productivity across the organization. I think there's more to come on that. On the right-hand side there, we're also pleased to say that we've been collaborating with OpenAI, which is the leader in the AI industry, the creators of ChatGPT. And OpenAI has released a product called OpenAI Operator. What Operator allows is for a user to use OpenAI and effectively an assistant or an agent that can go and do stuff for you across the internet. And what this assistant can go and do is book you people on AirTasker. And so you can be talking to OpenAI, and it's actually getting an agent to book through AirTasker. So we think this is a really great way to broaden our distribution as sort of Google starts to wind down as the main distribution level, and chat-based or AI-based products continue to ramp up. We think it's important to be ahead of that curve. It's also really important to be observing how users want to interact with AI on our platforms like AirTasker. So that's the investment into the core platform. Now, on the second page, we're going to talk a little bit about profitable growth. So in FY24, AirTasker generated about $45 million in its Australian business and a direct expense of about $14 million to generate about $31 million of cash flow in the Australian marketplace. So it's a really, really profitable and proven business model. How did we get here? If you look back in FY16, we were doing about 12 million in GMV and spending about $2 million in marketing. We then did a deal with Seven West Media in which they invested media in exchange for shares or equity in AirTasker. And you can see there that using that media that we were given by Channel 7, in FY17 and FY18, we ramped up investment from 2 million to sort of 9 million and 10 million for 2 years. And that allowed us to really build up a big volume of GMV run rate. Then in FY19, we started to focus a little bit more on profitability. And so we started winding back that marketing. But what you can see is that once you've got that escape velocity in these markets, the GMV continues to grow. And over the next 2 years, we wound the marketing back from close to 10 to close to $1 million of GMV, past $100 million of GMV. And in FY24, we did about $190 million of GMV in Australia with about $2.3 million of marketing. So you can see there, it's an upfront investment, build the network effect, get that scale. And once you've got it, you can really have a profitable business that generates a lot of cash. On to the next slide. If we look at that, what we're generating in Australia, the Australian business generates about $31 million for AirTasker. And that more than covers all of our fixed operating costs. So, for example, the platform, software, infrastructure, engineering, product, CEO, CFO, all of those things cost us about 18 million a year to run. So the cash that we're generating from our Australian marketplace completely covers all of those pieces and leaves about $13 million left over. So we could pay that $13 million out as a dividend, but what we see as a greater use of capital is to invest into the UK and the US to leverage that piece of software that we've built in Australia, establishing just a sales and marketing office in each of those markets to replicate those economics and generate more profitable marketplaces. So if you look at what we were doing in the UK, we invested a little bit of money into cash-based marketing, but then we thought, hey, we did this deal with Channel 7 in Australia. It proved that it was a great way to scale the marketplace and get those network effects. Let's do that again in the UK. So we took on board from Channel 4 Ventures, the Channel 7 of Australia, of the UK, about £3.5 million of advertising inventory in exchange for shares for about 20% in AirTasker UK. But so this is a really interesting bit. What we said to Channel 4 is that in 5 years' time, we'll come back and buy your equity back in AirTasker UK on a revenue-based multiple. So if you're doing more revenue, we're going to value AirTasker UK more and you're going to get a better return. And if you're doing no revenue in that business, well, we're not going to pay you anything for that equity. And so why is this so powerful is that it represents downside being ring-fenced. We're not gambling what we've built in Australia on the UK, but on the upside, it's completely performance-based media. The more revenue we get, the more that we have to pay for that asset, But don't forget, we own the other 80% of that asset. So that asset is becoming really, really, really valuable. And we've done the same thing in the US. We've bought on about $21.75 million of media investment, and Televisa Univision owns about 17% of AirTasker USA on very similar structure. So what this really represents is a way to turbocharge that lean cash investment we're making, ring fence the downside so we can always fall back to an Australian business, not the plan, but always important to protect the downside. And then on the upside, make sure we're only going to pay for this if it's generating a lot of revenue. So really, really a powerful investment structure. If we move to the next slide, you may be asking, if you look on the right-hand side there, so this is such a good deal for AirTasker. How can it be so asymmetric? Why is this so good for AirTasker? But when you actually look at it from the point of view of the media companies, they're getting locked in revenue for the next 2 or 3 years. We're really committing to invest through their marketing channels. And we're doing it through a proven business model that worked in Australia. We don't really have any fixed costs in these new marketplaces. We currently have about 2 employees in the US and 2 in the UK. So that's really important to not build up that fixed cost base in these new markets. And then they're getting a guaranteed exit. I mean, in 5 years, if they deliver revenue, they are going to get an exit which turns their media money into real value. And so this is a really great deal for them, and it's a really great deal for AirTasker. If we move to the next slide, as Mahendra mentioned, in 2024 calendar year, we did over $50 million in global media partnerships with some great partners that are listed up here. Channel 4 Ventures in the UK, iHeartMedia, Televisa Univision, Sinclair and Mercurius in the US. And these folks give us access to world-leading, world-class media platforms. But as we went through the process of deploying this media at scale across the world, we thought, how can we take our brand to the next level? We've got a lot of distribution. How do we take the messaging and the content and the way that we engage our users to the next step? And on the next page, I'm really excited to announce that AirTasker has entered into a team partnership with the Visa Cash app Racing Bulls Formula One team. So what's this all about? About a year ago, we were talking about, what are the different things that we could invest into to make our messaging super engaging and make our brand bigger on a global scale. And last year, I was at the Formula One and watching down on what people were doing in the Formula One paddock. And we were watching people, not the drivers, not the cars, we were watching the people behind the scenes, moving tires around, cleaning cars, disassembling furniture, setting up garages, moving all of the garage pieces from country to country. And we were like, wow, this is like the most industrious thing we've ever seen. All these people doing the tasks behind the scenes that make Formula One happen. And at the same time, we're watching the figures on how Netflix Drive to Survive is absolutely exploding. So on the next page, if you look at this, about 1.2 billion people are watching Formula One every year, and 389 million people are watching Netflix's Drive to Survive since it came out a few years ago. So this partnership gives us massive exposure in a really, really powerful environment. And I think as we launch into the UK, we launch into the US, creates a massive amount of brand cachet, which ultimately builds brand trust and likelihood of consideration to purchase. The second thing that we're doing is we're getting extensive content. AirTasker needs to build brand salience by constantly engaging and speaking with our audience. By having great content that we can develop alongside the Racing Bulls team, we're able to speak to our users without churning them and making them unsubscribe to our email list. So a great way to engage our audience. And then the third thing is, this is actually a very highly efficient marketing channel. It's going to cost less than 5% of our annual marketing budget in FY26. And so I think a very, very smart and efficient way to grow our brand, and unlocked by the fact that we're growing on a global scale. So on the right-hand side there, you can see some of our new collateral, which celebrates the team behind the dream, the team doing the tasks that make Formula One happen. You can see there Ed in Team Ops, Danny, who's an executive assistant, and Renzo, the technician who cleans and maintains the car, are really, really important characters to how AirTasker is going to scale its brand and distribution. So on the last page, just want to say thank you, everybody, for coming today and hearing about our progress and update. It's a challenging economic environment, I would say, in terms of consumer confidence and, a lot going on at the moment in the US and here in Australia as well with an upcoming election. But AirTasker is seeing some great bottoms-up performance coming through, and we're really excited about what we've delivered. So over to you, David, for questions.
Thanks, Tim. Thanks, Mahendra. A great presentation, and clearly an Australian success story. Now, we do have an opportunity to ask questions of Mahendra, John, and Tim, so please submit them using the Q&A button on your screen, and I'll put them to the gentlemen as they come through. Now, first question, Tim, you touched on at the end there the Formula One sponsorship. Have you seen any benefits from it yet? And is there evidence that the brand will be extended into other markets?
So in terms of the, what were our expectations of the Formula One partnership is more about building brand cachet and building long-term awareness, trust. And ultimately, I would say the most important metric would be brand consideration. So when you ask people in surveys, about AirTasker, how likely are you to use it in the next 12 months? That's the dial that you expect to go up. We announced the partnership about 3 weeks, so we haven't yet, recorded the metrics and seen that. But definitely engagement on our social channels and email and across our user base has been pretty compelling.
And in terms of other markets, I touched on it there with Formula One sponsorship, but another question's come through. Just asking, are you open to looking at other markets, or are you set to bed down the ones you're currently working with?
Look, I think with the current cost of capital and the fact that, I think we're in a bit of a crossroads in terms of where the economy is going to go. Is it going to go to our favour and interest rates coming down and go back into growth, or we got another couple of years ahead of us of more sanguine period? We are keeping our options open. And for now, we're very happy focusing on our our UK market, which is London, Birmingham, and Manchester, and our US market, which is LA, Austin, and Vegas. And we're being pretty disciplined with sticking to those markets for the meantime.
And what sort of growth rates do you see as success from the US and UK media deals? And what sort of time frame do you expect to see that success start to eventuate?
So we have a little bit of a model that we think is useful to sort of contemplate. And of course, it's based on anecdotal data that we've built as we scaled Australia as well as the UK market. And that rough model is that if you look at a 10 million person city, not a country, but a city, then over 3 years, you should be able to get from a standing start from 0 to 5, 10 to 12, and then 25 million of GMV by the end of year 3. And that would produce about $5 million of cash flow generation, which you could then reinvest into marketing and continue to grow that marketplace whilst remaining cash flow generative and profitable. Like you don't have to put in any more. In order to get there, we think that costs about $10 million of cash and about $20 million of media investment, which is done over 3 years. What's, I think, important to call out there is that the media investment tends to be straight-lined. So it's sort of 10, 10, 10. But if you can imagine how the revenue generates, it's quite a hockey stick, starting from 0, literally, going to 5 mil GMV, 10 to 12, and then 25. And for that reason, you're making that investment up front. And for that reason, we think it's really important to have a really great risk-managed and low cost of capital way of driving that growth. And that's what these media deals represent for us.
John, a quick question for you. How do you think the non-cash media spend, how do you think of it, when looking at reported earnings?
Yeah, it's a good question because it's obviously, it's sort of a bit like, R&D with it expensed through the P&L and capitalised to some way. Obviously, the accounting standards required to be expensed as used, but there's clearly some sort of short-term benefit, but mostly a medium-term benefit, which is sort of penalising on the earnings all up front. So, I guess what I would do is look at it pre and post, so at least you get a good and the company does disclose the non-cash sort of spend. So look at earnings reported, which includes all non-cash, and then exclude the non-cash spend to get an idea for what's going on underlying. Much the same as R&D. Some analysts will take capitalized R&D and actually add it to, or subtract it from earnings. But I find that's probably can be very harsh if that capitalized IT is actually genuinely for projects that aren't in the market yet. So it's sort of similar. Basically, look at it both ways, just to give you an idea of pre and post non-cash. The fact is, it doesn't. Obviously, the cash flow statement is unaffected by that cash charge in the P&L, the non-cash charge. So look at the cash flow also as a better guide to underlying earnings.
And John, just another question. In terms of, you followed the company for a number of years now, and as part of that process, you've made assumptions on and a model based on what you think the company will achieve. How do you think it's tracking against what you thought the company would do when you started covering it a few years ago? And what sort of guide map does that give you to what the future could hold?
Look, it's sort of early-ish days because the media capital spend, the real acceleration's really just been the last 6 months. But as I said in my brief presentation, you're seeing the right trends early. So all I can say is you're getting sort of those 200% growth sort of rates in the UK and US is what you want to see. Whether it should be 300, 200, 100, I'm really not sure. But I just want to see that obviously that return from the spend. And certainly in Australia, we're seeing a real reversal from a couple of years of negative GMV growth. Mostly to do with the consumer environment, which we saw across most retail stocks, and we're seeing a reversal of that as well. So that's a big tick. And again, the Australian media's non-cash media spend is still, we haven't seen a lot of that used up relative to the total value. So I guess in summary, we're seeing the right direction. It's probably the next 12 months. If you ask me in 12 months, I'll give you a better answer.
And Tim, what is the key KPI you use for measuring brand building success?
So we're predominantly focused on the leading indicators. So I think one of the worst things you can do about with brand marketing is just whipsaw back and forth and sort of expect to get an outcome if you're not consistent with investment into that. In the same way as capex into a restaurant or a network or a platform. What we look for is the leading indicators. And the leading indicators are predominantly things like unaided awareness. So that's asking the question, when you need someone to do something for you, when you need to buy local services, who do you think of? And that number increased by about 10% over the last period since we started investing into above the line marketing. The second thing that we look into is brand consideration. So that's saying of those people who said that they were aware of AirTasker, how likely are you to actually use the product in the next 12 months? And that was also increased by a multiple of that too. So we're starting to see those leading indicators come through. We're starting to see some of the lagging indicators coming through too, like revenue growth and GMV growth. And when you triangulate those two things together, you do get an idea that the marketing is working.
And maybe a Mahendra question. So these are your half-year results. Have you seen anything that's in terms of the trading conditions since December? Any insights that you're seeing now, both here in Australia but in the other jurisdictions in which the company operates?
So I think if we take the UK and the US, which we spoke about earlier, so the UK finished the first half just under 100% up on PCP, and then the US was just under 200% up on PCP. I'd expect that those trends would continue into the second half, and particularly as we're going into the peak season in the Northern Hemisphere. The business has a high degree of seasonality around it, so we see stronger demand and revenue through the spring and summer seasons in both the Southern Hemisphere in Australia and in the Northern Hemisphere in the US and the UK. So definitely those trends will continue. So we'd probably expect that revenue trend in the UK, which is 2x, and then the trend in the US, which is 3x on the comparative period to continue. In Australia, we finished the half 11.5% up on PCP. We're coming out of the peak season, so you'd naturally expect that to sort of slow down as we get into the winter and the colder months in Australia, which is just the natural trend.
And is that part of the thinking in terms of a northern hemisphere, southern hemisphere markets, that it starts to give you that opportunity to sort of not flatten, but to experience the benefits in both markets and ride the cycle, so to speak?
Absolutely, I think. Sorry, Tim, you.
Oh no, you go ahead, Mahendra.
Yeah, absolutely. So I think over time you'll have a nice sort of balanced sort of counter-cyclical business. That said, I think in the very, very long term, the market opportunity in the Northern Hemisphere significantly outstrips the opportunity in the Southern Hemisphere.
Now, just one last question, and Tim, ever the entrepreneur, so I'll let you ponder this one, and it is sort of a flow-on from a question asked earlier. Are there any markets that you look at outside of those that you're already in that you think this one is ripe for AirTasker, and at the right time and with the right partners, we'd love to go into it?
For sure. I mean, I would say if you looked at sort of the concentric circles outside of Australia, US, UK, you would look at sort of the developed English-speaking world, Canada, Ireland, New Zealand, countries like that, that are, have very similar dynamics to the US, UK, and Australia. And then looking at things like Western Europe would also have very similar socioeconomic setup, but of course does require you to jump over the language barrier, which is an investment into operations as well as technology to be able to do that. What I can say is we're seeing incredible inbound interest from media companies based on what we're doing in the US and the UK. They're like, that model is cool. So I think there we are being a little bit more disciplined with our approach and making sure that we focus on this great opportunity that we've got ahead of us. And we also think that if you win, a strong position in the UK and the US, there's huge opportunities to sort of leverage the brand cachet that you're building there into other markets, and the inverse may not be as true. So I think we've got the priorities right, and we're taking a very disciplined approach right now.
And just on that, probably an extension to that question, a lot of your media partners are global. Does that give you that opportunity to either be led into a market by them or easily retell the investment proposition to their subsidiaries in other markets?
So most of the partners that we've done deals with, I would say that although they do have local networks and local relationships, their predominant force is in those markets. For example, Channel 4 UK, oOh!media and ARN predominantly Australia, and iHeart, Televisa, Mercurius and Sinclair predominantly the US. So that is why we've incentivized them on this performance-based media structure, whereby they generate revenue in their country because that's where they got the influence, and we effectively pay them only when they generate that revenue in that country. So I think that that's where the focus is, but it certainly helps when you look at Mercurius, being part of the, ultimately part of Times of India, and some of these other groups having strong international networks. It definitely helps, and it also helps that these brands are just like the world's leading media brands. So we couldn't be more stoked to have these guys on board.
Now, I asked the question of John of what does success look like, and he made the statement that come back and talk to me in 12 months and I'll be able to give you an insight whether I was right on what I thought the future would hold. Tim, what does the future hold? I'm not asking you to forecast, but if we do look forward 12 months, what does success look like?
I think we really want to make inroads into the predictability of scaling cities in that model that I mentioned in the US.
You're asking too much.
And the good news is that we are zeroing in on that. The job will never be done of being able to perfect that launching playbook. But I think what you can see, what we've done in Australia, we've built this this business, which is incredibly cash generative, incredibly high leverage. And as we go into each of these new markets, the opportunity exists to do that about 50 times over. And so I think that is, what we're really trying to do is make that predictable. So we sort of talked about going from 0, 5, 10 to 12, 25 mil GMV in a city. And I think if we can really demonstrate that we're able to deliver on that, then we're in a very, very good place.
On that note, that does bring us to the end of the Q&A session. You've batted beautifully every question.
There's more people on Restream than there is the actual webinar,
which we don't always get, but we do appreciate it, answering the hard questions and dealing with them all in a very professional way. Thank you, John, Tim, and Mahendra for presenting today and for participating in the Q&A session. And to each of you watching online and who will be watching the recording when it becomes available, on behalf of AirTasker, thank you. Watch the company with interest, put it on the watch list, and let's see what the future looks like in 12 months' time.